CBA is defying APRA. Let's have a look. Hello everyone, Florian here and welcome to another episode of HeiseSays. Grab your stein of coffee because I want to talk about this article from Mortgage Business. It's about CBA offering a reduced buffer alternative. Now, APRA, what's the title? The Australian Prudential Regulation Authority, they dictate rules to the banks essentially and monitor them. And one of the rules is that when you're applying for a mortgage, the bank has to stick a percentage, a buffer on top of what the actual rate is to make sure that when rates go up, you can pay it. Because what's important is to ensure the banks are going to be solvent, that people are going to be able to meet the repayments and not borrow right to the edge of their ability. Now, sure, some people will fudge the numbers and some brokers and banks may, tell a few stories. But Australia is not going to be as crazy as what happened in the US. Over there, the stories you hear there about the GFC, how everyone with a pulse could get money and how they wrapped the mortgages all up together to sell them off. It was just a disaster waiting to happen. Now, the problem is, these buffers may sound good because, okay, that means people will have some breathing room. The banks won't get into trouble. It'll be nice, stable, boring Australia. But it also means you could be calculated at potential interest rates that we may never see, that you may never see in the life of your loan, and that may exclude you from getting a better deal. You may be trapped in a more expensive mortgage than otherwise. So let's check this article out because honestly, I think this is a good thing that CBA is doing. They're being sensible, they're managing their risks, and this is going to free some people from paying more money than they should. So let's check it out. So CBA announces a reduced buffer alternative. A Big Four bank has announced it will drop its serviceability buffer to 1% for qualifying refinanciers from Friday. So it's not everyone, it's just if you're refinancing. So say if you've got a mortgage and your loan-to-value ratio is good and you wanted to, get a new deal, but you're trapped. You're going from 6% down to 5%, let's say. But they're calculating you on 8%, 5% plus the 3% buffer. So they're going, sorry, you can't afford an 8% mortgage. But you're going, I'm not going to an 8% mortgage. I'm going to a 5% mortgage. It's going to be cheaper. I'll save more money. And they'll go, computer says no. Commonwealth Bank are taking steps to address that. The CBA has announced that it will bring in an alternative interest rate serviceability buffer of 1% for select customers from tomorrow on the 23rd, so a couple of days ago. Currently, the prudential regulator expects banks to test new borrowers' ability to meet their loan repayments at an interest rate that is at least 3 percentage points above the loan product rate. As such, borrowers who may want to take out a variable rate loan of around 6%, for example, would be assessed on the basis of being able to afford repayments of 9%. Meanwhile, standard revert rates for fixed-rate borrowers are currently around 8%. Making serviceability buffers unattainable for many borrowers. However, several lenders have been bringing in reduced serviceability buffers to help more borrowers refinance and save money on their home loan. Now, I know people are going to be going, will this drive up property prices? I can't see it fueling borrowing capacity for people entering the market. This looks like it's only people who are refinancing. So those of us who locked in at a super low rate, maybe for some absurd reason we didn't trust the media when they're reporting that the Reserve Bank wouldn't increase the cash rate until 2024, will give us more flexibility now. I can't see this adding fuel to the property price boom, or it really should be the property price obsession here in Australia. On Wednesday, the 21st, CBA was the second major bank to confirm that it would be making available a reduced buffer of 1% for eligible refinance applications submitted from Friday, the 23rd of June. Borrowers will need to pass servicing on the higher or alternative buffer rate or the floor rate of 5.4%. To be eligible for the alternative serviceability interest rate buffer, borrowers must have a loan-to-value ratio of 80% or less and no lender's mortgage insurance, have had their loan for a minimum of 12 months, have full income, expense and liability verification, refinance an amount that is no greater than their existing loan plus the higher of notional $10,000 or 1%, of the amount being refinanced to cover fees and or payout of existing loan payment cycle. Moreover, refinanciers cannot have any delinquencies across any CBA or any other financial institution products for the last 12 months, cannot be refinancing a guarantor property share loan, a bridging loan, a construction loan, or debt consolidation loan. Government guarantee scheme loans and additional top-ups or cash-out requests do not qualify either. So they're being pretty stringent here, so none of the 2% crowd. And by 2%, I mean the people that got in with a 2% deposit, not the people who got a 2% interest rate. These are different groups. Maybe one would have gotten the 2% deposit and a 2% interest rate. They're not going to get any chance at this. They're the ones that are going to be doing it tough, honestly. Speaking of the decision to introduce a lower buffer for certain borrowers, Michael Baumann, CBA's Executive General Manager for Home Buying, commented, "We know that due to the current interest rate environment, some homeowners are facing challenges refinancing their home loans. So we are introducing an alternative interest rate serviceability buffer of 1% for select customers who meet strict eligibility criteria. The alternative interest rate buffer servicing assessment rate of 1% will support customers refinancing existing home loan debts, which do not pass the standard 3% buffer over a 30-year period, principal and interest loan, but who would otherwise be eligible to refinance to a Commonwealth Bank home loan. CBA's move to drop," and I'm going to change this here. Hang on. There we go. Let me fix my camera. CBA's move to drop serviceability buffers in some expectations followed a similar move made by other lenders, including Westpac and its subsidiaries. According to the major bank, the decision to introduce the alternative serviceability buffer was made in consultation with the prudential regulator and followed further clarification and guidance from the regulator. Indeed, the chair of APRA, John Lonsdale, wrote to the banks earlier this month to remind them of the regulator's expectations when it comes to managing expectations of housing lending policy and warned them that any bank reporting large volumes of policy exceptions will be subject to heightened supervisory attention. Well, I mean, what's in the bank's best interest? Being under heightened supervisory attention or keeping more of their customers on their books? It's important that exceptions are used in a prudent and limited manner so as not to undermine the intent of the core policy. In using exceptions, APRA expects banks to make prudent assessment of repayment capacity so there is a good outcome for borrowers and the financial system, Mr. Lonsdale said in his letter. Prudent banks would have accepted reasoned and clear justifications for loans written outside policy, flagging that banks should also consider the responsible lending obligations. Well, looking at the criteria here that the Commonwealth Bank have set up for this, it doesn't seem crazy. It doesn't seem like they're not managing their risk. These are people who've probably made all their repayments and they just want to get a better deal. AMP's head of credit, Shane Scott, recently said the non-major banks would be sticking with a 3% buffer on its loans as it considers it to be very risky to ignore APRA's serviceability expectations. Our position at the moment is it would be very risky to ignore that. Yes, so they're sticking to the 3%. We've seen that before. So there we go. Let's have a bit of a chat about this one, guys. As I said before, I think this is a smart idea. I think this is a good move for the banks, and they're being sensible with who they are allowing to take advantage of this. If anything, this is going to keep more people, well, in their homes, or it'll keep the retail discretionary spending of these people at a higher level than it otherwise would have. That's the reality of it, isn't it? Because if you're at this level, you haven't been delinquent, you're meeting all these requirements. I get the feeling this is more, in a way, CBA keeping their clients, because now they have to compete with Westpac for these people, because they could go to Westpac and do the Westpac serviceability alternative. So, hey, the market provides, even in a hyper-regulated sector like this. Anyway, guys, thank you all for watching. Like, share, and subscribe to the channel. Check out HeiseBim or Heise Does, and if you're a fan and enjoy the content I create, you can support us on YouTube or Patreon. Use our referral links, buy our pocket squares, or call us if you need an architect. Take care. Have a great day. I'll see you all in the next episode of HeiseSays. Bye for now.